Welcome to Markets Now. I'm Michelle Rourke with Brad Koima of Koima Varlake. We're seeing a little bit of weakness over in the grains this morning. The livestock futures cattle are higher. We've seen two-sided trade in the hogs, but I think they're trading just a little bit lower as we talk. All right, Brad, let's talk about the cattle market. We're up this morning. We're coming out of this cattle on feed report, which looked neutral compared to expectations, but actually you think it was a little bit more friendly as you pick apart the numbers here, especially on placements.
Thanks a lot for having me on, Michelle. I always enjoy this program. I would agree. The numbers statistically, the marketing and the on-feed numbers very close to the guesses. The placement number, a couple of percent or more below the average trade guess, coming in at 102. So yeah, to the casual viewer, you might say, man, well, okay, still 2% more, but I think it's important to note that we are comparing to a very, 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 very low number last year. In fact, this year's number is the second lowest in the last 8 years. So the second lowest placement for January. To give you a little more perspective, it is 8% below the 5-year average for what we usually do in January. So, some of that is continued hangover effect of what's going on with the Mexican border, or what was going on with the Mexican border, where you saw the Texas placement come in at 86%. Remember last month it was 77%. So there's going to be some catch up there for sure. But the placement numbers, the only places that they were significantly big was the north, Nebraska and Iowa, both placing a few more cattle than the guys in the south, which has been a very consistent pattern, Michelle.
Yeah, I know you have the breakout of those numbers in terms of the placements in Iowa and Nebraska. They're all over 100%, aren't they?
Correct. And then you follow the placement number to the on-feed number, where there's two states that, well, Colorado, if you count them, but Iowa on-feed is 105% of a year ago, Nebraska 102%, versus Texas at 96 and Kansas at 99. And that's been a very consistent pattern for going upwards to a year now. I just find it kind of interesting. Of course, I'm a home field homer guy, right? I like the fact that we got cattle moving up here because I think we do a better job of marketing them. And I think that's part of the reason that we are getting more cattle. Our cattle are better. We feed them better. We negotiate for their price. Imagine that, which I think is significant in terms of how much you get for it. I'm just kind of happy to see, not that I wish any bad luck on anyone, but our feed's cheaper and all the rest. So it's nice to see the cattle migrating back up here where I think they belong.
So the board is responding positively to that this morning. We've held support areas that we need to. The key is, are we able to get that cash market to kind of put a bottom in? Do you think that's going to happen this week? Did it happen last week?
I think that's a very good question, and because it exactly articulates how this whole rally, it seems like, has been, where the futures have to be led by the nose by a strong cash market. This discount structure is frustrating. But in the past, that's what's had to take. Finally the cash. Oh, it's higher. I guess we better finally catch. So on the futures, yeah, I'll go out on a limb. I was saying last week that I thought maybe last week was going to be the low of the week, or the low of the move on the cash cattle. Maybe this week is. I don't know. It's either last week or this week, in my opinion. There was some instances where there was a tiny bit of firming here in my backyard on Friday, where there was a little bit of 201 paid after a lot of cattle had traded at $2 or less. The supply of cattle here in the north is very, very, very current. You've heard me make this saying, as Iowa goes, so goes the market, or the beginning and the end of all markets, whatever version of that little phrase I've said here on here. But I feel very comfortable saying that the supply of cattle here in March in this part of the world is less than it was in February. I think that the yearlings are still pulled ahead a month, with a number of guys telling me that, yeah, I've sold my last yearlings. And so I don't know. I'm not going to have much now until we get calves. So it's a long time till we get calves fat. It was perfect weather. We liked the price, and we couldn't wait to sell them. So I think as we gain a little bit of leverage back here, maybe it takes a little improvement in the margins for the packer, though I don't feel sorry for him. I think if we catch on the cash, I think their margins will improve too, because the boxes will probably rally after that as well.
I was going to ask you which catches first, cash or the box beef values, and box beef here has not really responded to these kill cuts. Is that a concern?
It is, to a degree. Impatient would maybe be a better word I describe it. And then I got to remind myself how I think anybody in the meat procurement business would tell you that February is tough. It's just probably the most difficult time of the year to sell middles, and middles are, of course, are the steak cuts. The weather is, it's after Christmas. It's after all the parties. I think I've even said on your show that a week before Super Bowl is kind of a mark it on your calendar. That's when you usually see a softness in the boxes start, and it was right on cue this year. Now we probably got to get to some warmer weather, and that's, well, it's nicer now here, of course, but I mean, for real, that's probably a little ways off yet. But my guess would be, the packer does have an influence on how much he sells boxes for, believe it or not. Cite the COVID rally. I would guess that what's going to catch first is the cash cattle, and then they'll probably try a little harder to move their boxes higher too. So I don't know. We're trading cattle futures. We're not trading packer margins. We're not trading box beef. We're trading what we think cattle are worth. And I think those two are two separate things. While they're connected, it's still different.
Gotcha. Real quick. Funds are record long over in the feeders, over 30,000 contracts. They're still long in the live cattle, almost 130,000, although they've exited a few positions. Do they keep defending that?
It's a very good question, boy. And if you could give me the answer, would you, call me up? Rule of thumb for me anyway is I'd rather be on the fun side than against them. I'd rather be trying to ride their coattails just to try to guess when they've got too many. Take the live cattle, for instance. The April cattle break $16, hold above the 100-day, hold above halfway back. Some of these real long-term, slow-turning funds like that turn off of a moving average, they've got a huge lead, and still do. And I think it's going to take more than this to get them out. So at this point, it seems to me like they want to defend. The feeder cows specifically are curious to me, even though the open interest is a lot smaller, so it's a lot easier to have a percentage of the record. There still seems to be a group out there that says, well, and how do you argue with this? The smallest cow herd since 1951, the smallest calf crop in 80 years or something like that. So that fundamental bias to like the feeder cattle futures. Plus, feeder cattle futures are $10 under the index here. So I don't know. Yeah. I guess I think I'd rather join them rather than try to fight them here at this point. And I'm glad they're on our side.
For sure. All right. Speaking of the funds, let's talk about the hog market. We opened a little higher and then quickly turned lower. Funds actually increased their length as of last Tuesday, even though we had a lower weekly close. So are they going to continue to stay in the market and party over there?
Well, it's hogs. Okay. So let me, everybody knows that I don't know the answers to the
I was going to say the short answer is who knows, right?
Especially for hogs, especially for me at least. Hogs are they become the new pork belly. So the fund position you talked about, and yet the last 3 days we've taken a whole bunch of open interest out of the hog market. Some of that was with the February expiration, but we probably took 15,000 of other open interest out of it. So, since you had that, bit of a sell signal, where you had that reversal down or a double top high and then closed below range gap lower, we haven't even looked back. I mean, you've got a kind of a toppy looking chart, other than the fact that when you pull off here to the June hog contract, you look at, well, what have we done here when we've gotten below 100? Well, we've held 1, 2, 3, 4 different times, and right against this 100-day. The demand news seems to be picking up a little bit, which I think also pairs off of the lack of good demand for the middle meats on the beef. So we switched that feature to something that's cheaper. I'm actually a little bit friendly on the hogs from here, just from the standpoint of I continue to hear how difficult it is to procure feeder pigs because of another round of disease. What seems to be a tight supply there makes me think that the summer months, at least from a supply side standpoint, would have some chances to rally. Of course, you can't talk about hogs without, given unless we have some tariff some repercussions from anything that we're doing with tariffs. But so far, we've been able to dodge those bullets too.
Yeah, no doubt. And when we talk about the hogs, the cutouts, I think the bellies were down over $30 last week. So I know that played a part or a role. Okay, so the grains this morning, a little bit weaker. What do you think? Is this tariff concerns reemerging? I know we're putting some sort of a tariff on ships that are coming in from China into the U.S. We've got, end of month coming here and the USDA ag outlook for them.
I think the tariff thing I think you well said. It's like the gorilla in the room. You know, you go, well, okay, so we seem like we've okay for now with Canada, Mexico, especially Mexico, especially as it relates to corn and to pork product for that matter. And yet it's still it's not resolved. It's just postponed, right? And at this point, the whole China dialogue has remained largely out of the talks. So I think that's maybe part of it. I could come up with I think your ag outlook statement is it's something that I'd kind of forgotten about. There's been a couple times where that little meeting has had some pretty big repercussions here in the market. For me though, the corn thing is a little, because I'm sitting in a high usage area of corn, okay, Northwest Iowa, where we feed and make ethanol and do all way more than we could possibly raise. So we're a huge importer of corn, and typically have a very strong basis because of that. This year we do not. In fact, the basis here is probably worse than it's been for maybe 5 years. Now I know that that's only part of the story, but it feels to me like there must be enough farmer-owned corn still, enough farmers selling to slow this thing down. The last part of this rally has been largely futures, not cash, so they will widen the basis, which makes me a little bit cautious. Now, you know, going into March 1 wouldn't be the first time we had a little sell-off, so let's see if that doesn't play that way. And I'm not a big fan of being bearish in April when, you know, you're still looking at a large area like my state, Iowa. It's a record dry fall. It's not like we're swimming in subsoil moisture here, so it's going to be a little easier to get some of that boost out of some weather scares as we go along. Yeah. But short term, I think the market feels heavy, and some of that I think is because of the whole worry about whether we're going to continue to have good relationships with our trade partners.
All right, thanks so much, Brad Koima with Koima Varlake. That is Markets Now.